All right, liquidity means having cash or access to cash to meet the payable liabilities. So liquidity ratios, for example, current ratio and acid test ratio, will give us an understanding how liquid our company is. All right, so the first one is current ratio. Current ratio means a ratio of current asset to current liabilities. This means current asset divided by current liabilities. So it will show the ability for a business to pay what it owes. Okay. Rule of thumb, it should be 2/1, which means your current asset must be twice the amount of current liabilities. Alright, so that is the ideal ratio. So remember, current ratio means current asset divided by your current liabilities. So the second ratio would be acid test ratio or quick ratio. Alright, it's similar to current ratio. The only difference here is we are only looking at the most liquid assets. Therefore, we're going to take out inventory. Okay, why inventory is excluded? It's because if you think about highly liquid assets, highly liquid current asset, you have cash, you have bank balance, you have trade receivables. Most all of it are highly liquid compared to inventory, because if you have stocks, can you convert it to cash as and when you need it? No, you can't immediately change your stocks or inventory into cash, because you need to find a buyer, then you have to you have to sell it, then you have to collect the money. So inventory is not a highly liquid asset. So you want to exclude that, and to find out how liquid is the company's working capital. So acid test ratio means current asset minus current asset minus inventories divided by current liabilities. Alright, so inventories are slow moving items and not very liquid, so we are excluding that. Current asset, we are excluding inventories divided by current liabilities. So your rule of thumb would be 1 or higher. Right? So let's look at illustration here. Alright, we're just giving some numbers for your understanding. So current asset, current liabilities. Alright, let's say in 2014 you have 260 worth of current asset, 150 worth of current liabilities, you get 1.73. And below, in 2015, your current asset is higher now, 280, current liability is also higher, so your current ratio is 1.37. So class, which one do you think better, 2014 or 15? Which one is better? 2014 is of course better than 2015, because 1.73 is higher than 1.37, which means you have more current asset to cover your current liabilities, right? 1.73 times you have current asset to cover your current liabilities. Here you have only 1.37 times to cover your current liabilities. But is it ideal? No. If you look at your thumb rule for current ratio, 2 or more. Alright, 2 or more is ideal. So if you get 2 or higher, that means the company has a current ideal current ratio. Alright, this is lesson. So both is not ideal, but of course 2014 is better than 2015. So it shows for every $1 owing to current liabilities, there's 1.73 to cover in the form of current asset. Alright, so 2015, the liquidity position has become worse. Alright, so it might indicate they have some cash flow problems. So with acid test ratio, alright, so you are just excluding the stock. Alright, so current asset minus inventories divided by current liabilities. Again, we just giving you some numbers to show an illustration. So one is 1.27, 2015 is 0.59. Which one is better? 2015? No, 2014 is better because it's higher than 2015, right? It's here is basically the reduction is almost half, right? 1.27 to 0.59. Is it ideal? Do they have an ideal ratio? Yes. If you look at the acid test ratio, it shows that your ideal is 1 or higher. So this is more than 1. So 2014 is ideal. Alright. But 2015 doesn't look good. It indicates poor liquidity this year. Alright. So potential new supply is likely to limit the amount of credit. Alright. If they find out your company has a lower test ratio, they know you might have a cash flow problem. So the new suppliers, they tend to limit, all right, the credit amount or credit days. Instead of giving 30 days to other companies, they might only give you 10 days, or they might refuse to give credit at all. All right, so that is the acid test ratio, and this is the illustration. So let's move on to the working capital cycle ratios. So if a business starts taking longer time to pay its payables, this could be sign of liquidity problem. Okay, so if your supplier give you 30 days, if you pay within 30 days, they will be happy. But if it shows 60 days, 90 days, that's a sign of liquidity problem. You don't have sufficient cash to make payment. If a business starts giving customers longer time to pay, it could be sign of inefficient debt collection. All right, let's say your competitor giving customers 20 days, but you're giving 2 months. All right, that shows you are inefficient in collecting debt. So receivables longer. If receivables take longer time to pay, that means your cash flow position of the business will deteriorate. It means you're not having sufficient cash flow to run your business. All right, next we're going to the receivables collection period or debtor days. Basically, average receivables divided by credit sales times 365 days. All right, so class, you can just use the total amount of receivables. All right, you don't need to average it. Okay, you can just take total receivables divide by credit sales. Why here specifically credit sales? Because you don't want to include those which has cash sales, right? You only take credit sales. So if there is no there's no differentiation saying credit sales how much, cash sales how much, then you just take total sales. All right. So receivables divided by sales times 365 days will give you debtor days. How long on average customers are taking to pay for the service of goods they have got it from a company. On the other hand, it's just the total opposite. You have creditor days, which is the payables payment period. So here's again trade payables. You might not need to take the average. Trade payables divide by purchases times 365 days. All right. Again, so class, if the question does not give you how much is purchases, then you can use cost of sales. All right. All right. So inventory turnover ratio in times, how many times the average inventory held has been sold during the course of the trading year. A low ratio could indicate the presence of slow moving ratio. All right. So inventory, how long it takes. Inventory turnover ratio. So how many times you basically buying in inventories, how that shows how fast your buying and selling of your inventories take place. So this will be calculated based on cost of sales divided by average inventory held, right? So this is in times. This is have inventory holding period. This is in days, which is your inventory divided by your cost of sales times with 365 days. So this shows how many days you will hold your inventories in your company. Alright, before you start processing, the day from you purchase and the whole the processing, how long it took, alright, until you sell it. The inventory held before is being sold. Alright, that's the whole period is called inventory holding period. Alright, so let's do an example here. So you have sales, cost of sales, right? Even distinguish purchases, receivables, payables, and inventory. Assumes all sales and purchases are on credit terms. Okay, so calculate the length of working capital or cash operating cycle. Alright, so class, you can start your calculation. Take out a piece of paper, start calculating what is your average payment period. How do you calculate the average payment period? Alright, so look at the formula given. Try out. So class, did you get 55 days? Alright, should be 21,000 your payables divided by your purchases times 365 days. Alright, so class, if you have purchases, then you use purchases. If you don't have purchases, then you could use cost of sales. Alright, so 55 days. What about average collection period? How many days? You should be getting 46 days, right? Your receivables amount is 31,250 divided by sales. 250,000 times 365 days, you should be getting 46 days. And the next one would be inventory turnover period. Find out how much is it. Your inventory is 92,500 divided by your cost of sales, which is 210,000 times 365 days. Alright, which should give you 161 days. Alright, so remember, for collection period and inventory, you'd be using, for payment and for turnover, you would be using, here you're using purchases, you're using cost of sales, here you're using sales. So your length of cash operating cycle would be 161 days plus 46 days minus 55 days. So you should be getting 152 days as your length of cash operating cycle. Alright, that's a quite long time. From the time you purchase and from the time you're getting back your money, it took about 5 months, 152 days. Okay. So in this kind of situation, alright, your company should think about a more effective or efficient way to improve cash flow operating cycle. So let's see how to monitor the working capital cycle. So this will be useful for comparison, all right, to look at the length of cycle in the past and assess whether the cycle is getting longer or shorter. All right, so these ratios will help us to determine how have we improved, all right, the past year or from the past, or we deteriorate. Okay, the working capital is shorter, that's a good indication. If it's longer, that is a negative indication. That means there's something, there's a problem in your working capital management. So longer working capital indicates larger investment in inventory plus trade receivables less trade payables. All right, so large investments and trade receivables have been basically tied up your cash flow. So that is a worse cash flow. When you have too much of inventories and trade receivables and less trade payables, that's a worse cash flow. But shorter working capital, on the other hand, which means you have a smaller investment in inventory and you have a low trade receivables. All right, minus payables, that means you have improved, your cash flow is better. So managers use your cash budgets and liquidity ratio to manage the cash flow and also liquidity. They have to manage the cash flow and how liquid is their company, their assets. It's very important to manage the day-to-day operations. So liquidity ratio can be calculated easily and quickly, more useful than cash budgets in identifying and improving worst trends. All right, the ratios are very useful when it comes to comparison. All right, if just 1 year, you might say, okay, this is ideal current ratio, not so ideal quick ratio, but it's even better when you compare. All right, ratios will give better useful information if you compare from the past data. All right, so with that, let's go on to the terms. All right, these are the situation when a company underutilize or overutilize the working capital. All right, so let's look at the first term, overcapitalization. All right, overcapitalization happens when firm has excessive working capital, more than what it needs. You have too much. All right, so excessive inventory, excessive receivables, excessive cash, and very few payables will lead to low return on investment. Right, with long-term funds tied up in non-earning short-term assets, which means what? Every month you only need 20,000 worth of inventories, but you're having 50,000 worth of inventories, all right, 30,000 extra. You only, let's say you only need 50,000 cash every month, but you are keeping 100,000 cash. So when it's excessive, then what do you need? What happens? Those excess amount of cash or excess amount of inventories that does not give you any return. So your cash is just being tied up in the form of this current asset that doesn't give you any form of return. So that is not something the company wants. You don't want to keep excessive cash and excessive inventories, which could be used to invest somewhere else, would have given you better return. All right, keeping current assets, inventories, cash doesn't give you any return. All right. So examples of overcapitalization: if your current ratio is way higher than 2, all right. Ideal is 2. If let's say a company has 4, company has a 5, company has a 10, all right, 10 times more current asset than current liabilities, so 5 times more current asset than current liabilities. That means overcapitalized. Your company is overcapitalized. Quick ratio, again, ideal is 1. If higher than 1, it's overcapitalized. Inventories and receivables collection periods being too long. All right, your collection periods, you're taking too long to collect money from your customers, and your inventories, you're taking longer time to turn over. That means that's another indication, being too long. Short period of credit taken from suppliers. All right, let's say suppliers giving you 30 days, but you pay them within 5 days. All right, so when in short period of credit taken from suppliers, that's another indication of overcapitalization. All right, usually companies try to lengthen the credit period what the supplier is giving, but you are taking shorter period. You're paying earlier than what the supplier asked. So that is your overcapitalization. So let's move on to the next one, which is overtrading. This is the opposite to overcapitalization, which is a business conducting its operation with inadequate capital. Inadequate means insufficient, not enough. All right, you don't have enough capital, but you are still conducting your business. That is called undercapitalization, or the common term is overtrading. All right, let's just break the term here. Trading means you are doing business, buying and selling. Over means you're doing your business beyond your capacity. So that is called over trading. All right. So it occurs when business accepts work and tries to fulfill it at a level that cannot be supported by its working capital, especially in new companies. All right. They will never say no when they receive order, even though they know they don't have the capacity, not sufficient working capital. There's no sufficient, you don't have sufficient machineries, not enough inventories, not enough cash, but you don't say no. If anyone asks, any customers going to order. So it does not have enough cash and cannot obtain enough cash quickly. All right, so either they don't have enough cash, or they can't obtain cash quickly. So in this situation, you cannot keep on taking orders. All right. So if a business can start overtrade when it's growing, and it finds it difficult to obtain long-term finance to pay for its growth. All right. So the small companies, when they're growing in the initial times, it's for them it's quite difficult to get long-term financing, especially for the banks. They want to see a track record. Are you in the business for some time, or you are new? If sometime you establish, you have a track record, then they're willing to give you financing. But if you are new, you don't have a long track record, they usually don't give long-term financing. They might just give short term. So in that position, when you're growing without the help of financing, you will face difficulties. So you want to have sufficient finance to purchase inventories and receivables with short-term credit. All right, so overtrading could be profitable, yes. All right, when you're taking lots of orders, you will be getting lots of profit initially. All right, you must remember, initially, yes, you might think you're making lots of profit, but in long run, you will suffer for a worsening liquidity. All right, there will be a point you don't have any cash because you use all your cash to buy inventories. All right, and when the time comes to make payment to your suppliers, you don't have cash. When the time comes to pay your workers, staff, you don't have cash. So that is the time you're having bad or worsening liquidity positions. So that could lead to danger of bankruptcy. All right, when you don't have cash, you can't pay interest, you can't pay your workers, so your operation will have to stop. All right, then you have no choice. You might have to go insolvent, bankruptcy. Right. So that is a possible chances of company going into bankruptcy because of overtrading, right? Doing business beyond their capacity. All right. So let's look at the symptoms. The symptoms are greatly increase in sales. Class greatly increase. If you write your answer as increase in sales. So if I ask you a question, what is the symptoms of overtrading? If you say increase in sales, that means wrong. All right. Increasing in sales is how normal business works. All right. Gradual increase every year. The sales increase by 10%, 15%. It's fine. But the key here is the key for overtrading is greatly, all right, drastic increase in sales by 50%, by 100%, by 200%. That is a symptom of overtrading. All right. The next is increase in receivables and longer time to pay. You find out the receivables amount is keep on increasing. Last year from 100,000, now it's 200,000, then to 500,000, and it shows customers taking longer time to make the payment. All right, on the other way around, you're taking longer time to pay to your suppliers. Okay, that's another indicator. Unusual inventory movement falls sharply, responds to growing sales demand, and increase significantly as the business buys more. It means suddenly your inventory level dropped, all right, almost zero level. Then when you buy the new inventories, it'll increase sharp. Let's say 80% of the capacity or 100% of the capacity. So that is the unusual inventory movement, which falls sharply and increase also sharply. Falling of current ratio and quick ratio, as I said before, your current ratio, if it keep on reducing over the years, that means your chances of having overtrading or quick ratio, so is falling over the years, that means you might have overtrading symptoms. And another point is rising in bank overdraft. Since you cannot obtain long-term financing, so you would max out your overdraft facility. So businesses that overtrade can run into serious risk because they are relying too much on short-term finance. As you know, short-term finance, there are chances of your interest rate to increase, and again, your short-term finance, if you're unable to make your interest payment on time, or if you're unable to pay back your principal, they're highly likely the bank can take legal action against the company and can make your company go into bankruptcy. Right? So companies that is overtrading, there are high chances, possibilities going to insolvency. All right. So with that, we're completing chapter 2. Thank you.